Well, hey there. Hope you're having a great day. We're going to talk about electric vehicles again and how to invest in electric vehicles or battery electric cars, EV investing. This is a new trend. It's not that new, but that's what we're going to talk about today. So JD, this post is for you. I've continued to do some research to kind of try to figure out what's the best way for us to invest in electric cars. So I'm going to show you some of the tickers that we're looking at, some of the strategy. Well, it's really one part of a strategy, investing in electric cars, the car of the future. So again, JD, this is for you. And the post, by the way, is at missionalmoney.com. So Missional Money is an educational platform for financial training for investors and financial advisors, and it's also a podcast. So if you're listening in iTunes, don't forget you can jump over to missionalmoney.com, go to the top of the page, and you'll see where we have a YouTube icon, which you can actually watch my lips move. And for JD and some others who we're working with, this is something I do every day, investment management, but this is not a promotional and certainly not investment advice. It's only fiduciary investment advice if you're a client. So anyway, let's just jump through the post that I made today. It's a little bit of research that I've been doing for my own benefit and for my clients. And so we'll go through, I'll show you the charts for each of these companies that are listed in today's post. What I've done is just tried to, in fact, I got most of this from Investopedia. That's a great source if you don't read Investopedia, but they did a good job of kind of highlighting individual automakers like Tesla Motors, Toyota. And so when you think about it, General Motors, Ford, everyone is getting into the battery electric cars business. But the goal is, I think, for us as investors is to look for the best opportunity. I got to tell you, my crystal ball it's been broken for a while. And when you look at, I'm going to jump over into just take a look at, so I created a watch list for battery electric cars or EV electric vehicles, however you want to, but I just named my watch list cars. And so if you look on the screen, you'll see all of the tickers that I have listed, and some of these are ADRs, which mean they're not traded on U.S. exchanges, and that's one of the things I'm finding. One of the risks is choosing the right investment in terms of the location for the investment, which stock exchange it's traded on. So this is just a conversation. I hope you'll leave your comment, and if you're watching on YouTube, leave a comment and I'll certainly read it, and the next time I update this post I'll give you a shout out. But so I want to jump into the charts and just look. I've been building this watch list for some time, a couple of weeks. Client wanted to add electric cars or just cars in general to the portfolio, and I've been doing the same thing. So let's just start with, this is Tesla is probably the most well-known, and Tesla has a pretty big price tag. So if you look at let's just take a look. We'll start with Tesla, and then I'll show you one that I found that I kind of like, but it scares me, and I certainly wouldn't recommend it to a client because it's Lucid Motors. I think they're going to be a competitor with Tesla. It's got some cool things going on. But anyway, we're looking at a 6-month chart of Tesla. You can see that Tesla, so let's go to a 2-year chart and put it in perspective just for fun. I mean, Tesla is like the premier electric vehicle, battery electric car. If you've ever ridden in a Tesla, you know it's a remarkable machine and pretty fascinating leader, although the stock is very volatile. But if you look at a 2-year chart, you can see it's trading above its 200-day moving average. It's trading above its 50-day moving average. But if you look at that chart, you'll notice that that's not always the case, and this thing goes up and down. So it's trending up for the time being, but it's down from where it was around January of 21. January of this year, it was up around $900 a share, and today it's trading at $739. But if you look at a 6-month chart, it's been trending up. But look at the consistent pullbacks you have in Tesla. I'm afraid of Tesla. I mean, I wouldn't really want to own. If I did buy Tesla, I would buy it for a short term, and I would buy it in a tax qualified account so I could turn around and sell it when it had a big upswing. So let me show you one of the things that again, none of these are recommendations, they're just ideas. But this is the company that Lucid Motors. It's very new, very small, which always means it has more risk. But if you think about it, Amazon, Apple, all of the companies that we know that have created huge profits, they all started out slow, and they all went through some strange gyrations for lots of reasons. Lucid is under attack by short sellers, and yesterday it was down like 14%. So today I think it's up. Yeah, Lucid is up 1.63%. It's up 29 cents, but it's a single company, and so the whole point is single companies, individual companies are loaded with risk, more risk than, say, an ETF. And I'm going to be recommending to my clients at some point an ETF strategy, an exchange traded fund, just because it gives us much more diversification. It's a much better way to manage risk. An ETF trades like a stock. So if we have it in say it's in an IRA account, we could buy that ETF on days when it was down. Like if you look at ARK, I think we have ARK. ARK is another, that's an ETF. It's up 1.3%. But if you look at the chart, this is an ETF which is filled with electric vehicles and batteries and innovation. It's called the ARK Innovation Fund. So this is a good proxy if you want to buy a whole bunch of companies that are in the same niche, the same business, the car business, but focused on innovation or the electric cars. So you look at this chart, and while I've put some of this in clients' portfolios, and I've certainly purchased it in my own accounts, I'm just not, it's got a lot of risk. There's just a lot of unknowns. So I'm not, again, making any recommendations here. I'm just trying to help those of you like JD and myself and others who are interested in how do we invest in this niche. So this is not cryptocurrency. That's going to be another series, so stay tuned for that. But the electric car industry is one that's filled with lots of question marks, but obviously some opportunity. How do we pick the right company? How do we pick the right investment, whether it's an ETF or a few companies that we create our own little mutual fund with? All of those are possible, but I'm certainly not at this point ready to make any commitments. I am kind of interested in, I've been watching each of these over the course of the last few weeks as I'm building this watch list, and they really didn't do much. Today they're popping pretty nicely, so I think we will keep an eye on. Let's see if we can take a look at the heat map view and see who's up, who's down. So one of the ones that's down is this Vroom. That's not really doesn't fit into this strategy, but Vroom is it's a company like CarMax. They help you buy a car without a dealer, or I guess with a dealer. I'm not exactly sure, but it had such a massive drawdown, and it's starting to come back. So it's another one of those risky kind of opportunity plays. But again, no investment advice here, no recommendations, just here's some things I've been looking at. So I'm going to be keeping a list of this. I'll post a list of the tickers that we will be reviewing in future episodes, so stay tuned. But for this episode, I just wanted to kind of come back to the table. JD, I owed you an update, and that's pretty much my update. Is I'm still researching, still looking. I think the way that I'm going to want to play this is to basically pick a few and put them on the top of the watch list, and when we have really nice pullbacks, we'll start to create positions. And I think over time, again, if we're dealing with tax qualified accounts, like my IRA, Roth IRA, I think these are, because they have so much movement, so much up and down, I think that the way to invest in these for the next few years is going to be look for some consistency, find some high probability patterns that we can trade. And I'm not talking about day trading, I'm talking about, over a series of weeks as we watch the market hit new highs. It's unbelievable. The air is getting very thin at the top of these charts. And I, as an investment advisor, that's something that gives me a good deal of concern for my own investments and for my clients. And I'm not going to pretend that I have a crystal ball, but if we look at just look at the SPY, the SPY. This is I'll wrap it up here for today. But if you look at the SPY, that's a 2-year chart. Just look how high that goes. I mean, how it's just gone up, up, up. And then, of course, you look at, that's a 2-year chart. So you can see in March of 2020 what happened on that chart, a pretty significant pullback. So let's just take a step back and go to a 5-year chart. And if you go to a 5-year chart, you'll see another dip right there in the center of that chart, which is back in December of 2018. And that was back when the Fed decided they were going to inch up interest rates. And we're in the same position today in terms of the Fed. We're waiting and watching, paying close attention to what they say and what they do. And that really, to me, is going to be one of the most significant things that move the needle in terms of the market. So I'm waiting and positioning for the next pullback. And, you never know if it's going to be a 5% or a 10%. But if you look at that big blue line there, that's the 200-day moving average on a 5-year chart. And so it's way above the market, the S&P 500, which is the best proxy I know of for the market, the S&P 500. And the SPY is an ETF, an exchange-traded fund that contains in equal proportion all of the 500 company stocks and the Standard & Poor's 500, the S&P 500. So that's what the SPY is. It's an ETF. This is the chart of the SPY. It's the most highly traded, or certainly one of the most highly traded ETFs or securities across the board, and for good reason, because it represents the S&P 500. So it's the one that I watch the closest. When I'm looking for patterns or I'm looking for highs and lows in the market, for making decisions on really taking risk off or putting risk on, it's the SPY that I'm looking at the closest. So that's a 5-year chart. The 6-month chart. August isn't supposed to be a very strong month in the market, but we've seen new all-time highs this month multiple times in the SPY and the S&P 500 and the Dow and the NASDAQ. So this is the SPY. Again, it's the one that is most indicative of the market. And so the market is fueled by the Fed and printing money, and the Fed is at some point going to kind of close the buffet a little bit. And at some point, I think Congress is going to have to stop spending money like drunken sailors, but today they appear to be on a full binge with spending. And all of those things are causing the market to really be able to only go one way, which is up. So that's all obviously part of the risk that's involved in these new technologies, these new companies. Currently, every one of these new companies, at least in the US, is getting access to very low cost capital. And so there's a whole lot of them. And at some point, there'll be some event that will weed out some of the less productive companies. But right now, it's really hard to say. It's really hard to see. Fundamentals don't matter the way they used to. But there's still some really good stories, and that's what we're paying attention to. Which companies are going to be the companies we want to purchase? So as I wrap it up, I want to say one more thing about really picking the right investment. Typically, not typically, but fundamentally, I like ETFs. I prefer to avoid mutual funds for just mainly because the expenses are too high and the benefits are too low. And in a mutual fund, I like, if you think about something like bread or gluten, and when you buy a loaf of white bread at the store, it doesn't matter what brand is on the loaf, but it's just filled with gluten, non-nutritious ingredients that really may taste good or look good, but they're not good for you. And so mutual funds are kind of that way. In my experience working on Wall Street at Morgan Stanley, their platform was filled with mutual funds, and those mutual fund companies had to pay a fee, pay to play, to be on that Morgan Stanley platform. So I've been exposed to Wall Street and investment management at Morgan Stanley in the wealth management department, and one of the things that I learned is that you know, just because you have a brand name like Morgan Stanley, or you name the mutual fund company, they're always going to be doing their window dressing. They're always going to be doing their backroom deals with companies that get into their fund. And so you just never know what kind of gluten you're getting in the mutual fund. Whereas an ETF is more like an index fund. It's not picking and choosing. It's just based on certain criteria. The expenses are much lower in an ETF, an exchange traded fund, versus a mutual fund, because you don't have a manager. You're not paying the fee to have a manager pick and choose stocks. So I just much prefer, one of the things that was important to me when I set up my own firm, I wanted to be able to offer clients investments that were the kinds of investments that I wanted to make myself. And so we're able to do that today using ETFs. But these ETFs, even these funds that are in our cars watch list, they're very thinly traded, and so that's a big concern. One of the metrics I look for is an ETF that has a high volume, so like the SPY, huge volume. In other words, it's trading a lot. Just get the law of large numbers helps you predict better and find a higher probability of success if you're able to look at a pattern or a chart that's dealing with high numbers instead of low numbers. So a lot of these new ETFs have very low volume. If I look at ARK, which is a very well-known, very popular ETF, it's like it looks like 21,000. I wouldn't trust this app to be accurate for the volume, but if you look at SPY, for example, just to see, so you see what I'm talking about. If we jump into SPY, so SPY says 85,000. Oh, it says average volume. So that was today's volume, sorry. When you look at the right side, it shows average volume, 56 million shares in SPY. And I've seen it well over 100 million shares traded each day. It's only 11 a.m. Central Time, so that volume on the left side is how much it's traded today. But that's an indicator that we look for. So now ARK, it doesn't show the average volume, but trust me, it's not near as high. And that's one of the things that each of these ETFs and even the individual company stocks, they're going to be lower volume. So if you look at something like GM, 20 million shares per day. If you look at NEO, it's a battery maker, look at that, it's trading average 40 million shares a day. So don't ask me why that's trading so high, such a high volume, but I would much rather invest in a stock that has tremendously high volume. It's just going to be more predictable. And when it comes to risk management, that's one of the metrics I'm looking for. Typically on an ETF, I'm looking for very high volume, meaning there's lots of trading. Number two is low expenses. That's always key. On these smaller ones, the expenses are definitely higher. Like SPY has about I think it's 8 basis points expense versus most mutual funds that have over 100 basis points. So SPY is a great proxy. It's a great investment. If you could only pick one investment, it'd be SPY, but that's not going to give us the exposure we're looking for in specific areas like these electric cars. But the electric cars, one of the risks that I'm paying attention to with the ETFs and the electric cars is the volume, the cost or the expense, and the liquidity, which is really important. And the smaller the volume, typically the smaller the liquidity, which means the spread between the bid and the ask gets very large. And on days when you have to make trades, that's a pretty important factor. So if you look at an ETF with a very low volume, you could have a big spread like $1 per share. If you look at SPY, it always trades with about a penny spread between the bid and the ask. And so that's inside baseball, but it's one of the metrics that I look for on building a portfolio that's going to be effective in terms of managing risk and opportunity moving forward. So lots of things to look at. Again, JD, if you've got any input and you want to get back to me, we can have a conversation. If you found anything, by the way, anyone who's listening or watching, this is being posted to the podcast and to our website at missionalmoney.com. This is purely educational. This is my disclaimer. This is, by the way, if you haven't checked it out, we have a financial training course at missionalmoney.com. You can enroll. It's free. It's for investors and advisors. It's a premium platform, the same platform we use for planning with clients. I've been teaching at the University of Houston for many years, and with COVID, we started doing online training, and so I incorporated the students create their own financial plan, a comprehensive financial plan during the course. So I had to create that course online, and it was a lot of work, but it was very rewarding work. And now what I'm able to do with students is really remarkable, and I wanted to make that available to my clients and also to family and friends, and for other friends of mine who are financial advisors who have not invested or their companies haven't given them the ability to do financial planning with their clients. This is a very collaborative platform. If you're a client, you're already registered, and it's free for everyone. So tell your friends, tell your family, and it's at missionalmoney.com. I'll just jump over there real quick, and you'll see at the top of the screen, top of the page rather, investor, advisor, and your plan. So if you click on investor, it will take you to the course, Make Your Money Count. And I'm building that course now. But it's ready, it's open, and like I said, if you're a client, you're already registered and enrolled. If you're a financial advisor, we're building that course too. It's not quite ready, but that's the website is open and ready to enroll. And then when you go to your plan, this takes us to the premium planning platform, like I said, which is what we use with our clients at Bayrock Financial. But it's also what we use to teach our students at the University of Houston at the Bauer College of Business. So when you go to that home page, at missionalmoney.com, that's what you'll see at the very top. We built that into the header so it's easy to get there. So you can get to the course if you're an investor just by clicking on the big blue investor button. If you're an advisor, click on the advisor. And again, as I close out today, I just want to kind of mention for the purpose of the podcast that this is the book that we use for the training, Make Your Money Count. And if you're an advisor, I wrote this book called What Matters Most. the whole point in this book, the first word in this book, first line, is that trust is what matters most in any relationship. And so what I found when I became a certified financial planner is I didn't have a very good system. I didn't have a very good process for doing financial planning. Turns out the best way to build trust is to help clients with financial planning. And to have a good system to do that, I had to go to great lengths to learn from mentors who taught me a really great approach. And so I put it into what I call the blueprint for financial success. And so this is the key kind of signature tool that we use for our financial training for investors and advisors. So again, thanks for letting me share my commercial. If you're still with us, please don't forget to leave a little 5-star review for the podcast. It's Missional Money. You can find it in iTunes or anywhere podcasts are played. And if you're a client, don't forget you've already been registered, enrolled using your email address at missionalmoney.com. If you want to talk about your plan or take any of the modules, you get special attention, and anytime you want to meet with me, you know how to reach me. And it's for you and your family, and I hope you find it helpful. If you're not a client at Bayrock, if you're a student from the University of Houston, you have full access at missionalmoney.com. Look forward to visiting with you inside the course, and so we'll see you next time. Have a great day, and thanks for watching our update on electric vehicle investing. More to come. You can go to the website missionalmoney.com, and the category is investment strategies. That's where this post is being posted on the website. So have a great day. We'll see you next time.